Hello, ladies and gentlemen. Welcome to task 2 of the pro section, which is just an extension of part B, what you've been doing in task 1. Task 1, you've been getting familiar. I just wanted you to get familiar with merging, playing around with volume profile, all the settings that I told you about. Really, you needed that bit of time. I don't really want to put a time limit on it. If it's taking you a few days, fine. If it's taking you a few weeks, who cares? It really doesn't matter. It's taking you as long as it needs to take you. That's the point. There's no, pressure or anything to finish with task 1, but this is really just an extension now. I want to move you on and actually start to get you marking some of the levels that you've been doing. But I just want to make a quick note before you do that around. So there's a bit where you may have noticed at the moment it's called Discord. So I've got a Discord room which I explain in the Discord section. The reason I've left the section separate and I've put similar here is because, look, you might be watching this in 2, 3, 5, 10 years time. I don't know. These concepts have been working for a lifetime. At the end of the day, it's just what? Demand and supply, buyers and sellers, right? Since human beings came into existence, this has been working. So this is going to work well after my lifetime. So all of this stuff is still valid, but who knows? There might not be a Discord in a year's time, 2 years' time, 5 years' time, 10. I don't know. There's going to be something. It could be a different platform. It could be something completely different. That's why I've kept it different. But as of the time of me recording this, is a Discord. So whatever it is, whatever medium we've got to bring everyone together, essentially, whatever we're using, obviously at the moment it's Discord. The purpose of that is, what it is obviously I want to replicate what is happening in a professional environment as closely as possible. So what I want the Discord or whatever it is we're using to really become is a virtual institutional trading floor and a space where I want you to feel as if you're in a professional environment, okay? None of this, no offense to anyone using it, technical analysis, squiggly lines, all that stuff, no. This is, and I said to you, I've been quite open and honest. In 16 years, I've never seen that stuff used before. So, it would be unrealistic for me to have an environment where you're doing all that retail stuff, right? I'm trying to create a professional environment. I can only go by what my years of experience, and I think that's a decent amount of experience for me to comfortably tell you that, look, in a professional environment, all that stuff isn't there. Let's create a professional environment where we're looking at professional tools, right? And professional approaches. It makes sense. So I want to create a virtual institutional trading floor. There's loads of people in there. Let's do it together. Let's treat it as such, a professional environment, exactly how it would be on a professional trading floor. You don't need to be there all day long. It's not that. Obviously you might have work, you've got family, you've got whatever. But when you're there, you're there. When you're not, you're not. But when you are there, I want it to be a professional trading environment. I want you to share ideas. So what do I mean by that? I want you to, let's share ideas together. There's no right or wrong. I want you to put your task 1, task 2, however many tasks the pro course ends up being, and then even after, where you get into full sort of simulator mode, or if you even develop further than that, and hopefully you do, whatever, much further down the line, whatever it is you're doing, share openly. There's no right or wrong. It doesn't matter. If your analysis ends up being, completely wrong, it doesn't, because you don't know what's going to happen, right? You don't have a crystal ball. I don't have a crystal ball. It's more about, how rigorous was your analysis and how logical and how analytically rigorous was the process that you went through. What the market decides to do to a large extent is obviously, in fact, to a complete extent, it's out of your control. So you don't know. So, which kind of leads me on to my next point. Whenever I was in a professional environment, professional traders, they never hid anything. And I'll tell you that quite openly. Traders would be quite open with their prep, and I did find this. Investment banking, I'll be honest with you, was a little bit of a different environment. In particular, like in some of the market making areas, and that weren't pure outright speculative risk taking. But as soon as I got into environments where you were taking outright risk, you worked as a team. There was this camaraderie, as I've put here, and yeah, you worked in a team environment. It was really important to share ideas, help each other, because at the end of the day, you're all going to benefit. So I've put the link there anyway, as in there's a video after this. At the moment, it's Discord, obviously. I don't know what it's going to be when you actually end up doing the section, but there'll be something there. So at the moment, it's Discord. So jump on and just remember this, that be open, don't be worried, don't be scared about, oh, I don't know if my idea will work out or not. Doesn't matter. You don't get points for P&L. You get points at the end of the year, end of the month. Obviously, it is, ideal that you've made risk-adjusted returns. Of course it is, but come on a day-to-day basis, you're not going to learn if you're always worried about, should I post this? Should I not? What if I lose? What if it doesn't matter. Honestly, we can worry about, like I said, your combined results over a month, 2, 3 months, 6-month period, and reflect on that and figure out where things might be going right or wrong. But day to day, guys, just go all out, and people will help you. Obviously, if I see something, I'll be able to help you if you're more open. If you're not open, then I'm not going to know, am I, what you're doing right or wrong? I'm really not going to have a clue, and nor is anyone else. So, and I say this in the video, I can't obviously guarantee that I'll be there every day, but I'll try to be as active as possible. So just remember, basically, these sort of ideals when you're in the room. So that's enough on that. So what is task 2 about? Well, task 2 really is, I want you to continue to work on composites, obviously where you've got profiles, and obviously in an ideal scenario, they're going to be balanced like this. You combine them, don't you? But the point is, when you come up with this one large composite, now what I want you to do in this section is we're really going to start marking these so that, when the market comes back, we can decide, what do we do in this situation? What do we do in this situation? What do we do in this situation? What's our expectations, those kind of things. So really I need to show you how I mark these levels on, obviously, the platform that I use, Sierra Chart. And then I mentioned, I don't really split them out, but what I'm going to do in this section is, I realized I don't want to, you're going to see when I come on to institutional expectations on the next slide, is that I don't really want to give you one example for this expectation. No, what I'm going to do is I'm going to go through a market, either the E-mini or crude oil, and I'm literally going to go over, as of today, the last, say, 3-4 months, and we're going to have a look at how some of these institutional expectations play out. So do you know what? Rather than talk about it too much here, I'm going to go on to the next slide now. And then I'm really going to show you what I want you to be looking out for in task 2, but also I want to start to introduce some expectations, which is really going to help you develop edge and look for building some rounded ideas about trading strategy. And I'm going to show you what institutions are doing, pretty much, because obviously I've had the exposure, so I've got a very good idea of their expectations around different market conditions. When the market's balanced, rotational, or imbalanced, what are the expectations? What do institutions program their algos to look for? Not only algos, but obviously their individual traders, or people that are even trading like investors on bigger long-term value. What are their expectations generally? So we're going to talk about that on the next slide. Let's go to the next slide and it'll become a lot clearer what I mean. Okay, so what I've done for you, okay, and I've actually never done this before because I've always taken this for granted. And look, I don't want you to think, just because I've written Envy's institutional value expectations framework, what it is this is actually, all I want you to think of is this being a value expectations framework for institutions? I'll put my name there only because I've organized this. That's the only reason. Because the reality is, I told you I'm going to teach you everything that you would get taught in a professional firm. And they'll tell you some of these things, but it's not very well organized, you know? So this is where my years of experience are really adding value to you, in my opinion. From my own experience, I wasn't necessarily taught this in a very structured way, and I'm really trying to reduce, as I said, it took me a long time to really recognize a lot of these things through observation, and you're still going to have to put in the time. You can't get past that. But the point is, rather than you fumbling around like I did for a long time, I want you to start with the expectations and observe them, okay? You can amend them as you want, and I've said this many times, I don't want you taking my word for this. Just observe according to what I have experienced. And by the way, if it helps, and it should give you a lot more confidence if I say that, look, you already know that I've worked, a big part of my life in institutions, and I can tell you, and I've obviously been involved in working close with algorithmic building and also traders that trade value, essentially. And I'm talking large amounts of money trading value in the way that I've showed you. And I can tell you this is exactly what they're looking at. I've never seen it written out like this, but I know that this is what they're doing when they identify conditions. So I don't want you to think that, oh, Envy's made up some rules for us and it's Envy's indicator. And guys, complete garbage. It isn't. All this is my logical observations over many years of what I've seen institutional algorithms look for, which you saw. I kind of showed you this stuff anyway in the depth of market. So you don't need to take my word for it. You've been on the depth of market and you can observe it. You can see when the market's balanced, it tends to stay balanced, right? It's logical. This isn't an indicator that I've programmed and developed and it's some magical formula. No. And I don't mean this in a patronizing way. I'm trying to help you when I say you've got to get rid of that thinking. It's all garbage. It's not going to get you anywhere. What it is these are just very logical expectations, not only in financial markets, but in every traded good and service in the world. I've already said this before. So for example, if the market is happy selling iPhones at £1,100, it's going to stay at £1,100, isn't it? It's not going to disappear to £2,000 or drop down to £600. No, when the market is balanced, it stays balanced. So that's all I'm saying is, I haven't invented any of this stuff out of thin air or come up with some framework that I think, oh, let me go and test this. No, not at all. The market has told me this. My exposure to some of the world's best traders, I've seen it with my own eyes that this is what they're doing. Obviously, I've been involved in development of algorithms that trade around volume profile. This is what they're all doing. So guys, this is what professionals are doing. It may not necessarily be written out. Obviously, people don't, I'll be honest with you, professionals don't necessarily want this on, written out there in public. So before I've said in the etiquette section, and I've said, look, I don't care really if anything's out there and whatever. I'd prefer you didn't, out of courtesy. This, however, I would really appreciate, not because it's some magical indicator or tool or whatever. Look, at the end of the day, I'm an institutional guy. I'm a professional. I've extracted a lot of this, yes, through observation, but also through observing what professional people are doing. And I know people wouldn't appreciate if this was plastered everywhere. All right, so I would politely request that by all means, show your friends, whatever, who you think are professionally inclined. By all means, do all of that stuff. I've got no problem with you discussing this with people. But obviously, like I said, in public forums and things like that, I just think it's professional courtesy that you don't go and, print it out, take copies of this, do whatever you want with it. Keep it in front of your desk, plaster it all over your walls, I've got no problem with it. But obviously in the public arena, I think there's a reason why professional firms or institutional guys or algorithmic traders don't necessarily post all this stuff all over the internet, because it's something that out of professional courtesy, and it's just one of those things that isn't necessarily put out there. And don't get me wrong, it isn't like some black box secret that is the road to riches. It's absolutely not that. It's just more about professional courtesy, and I've seen that in professional environments, is that people like to exercise a lot of that if there's an understanding or whatever. I probably haven't explained it very well, but hopefully you understand that it's not that this is some secret that's going to make you millions. It's just obviously that obviously guys that are doing this sort of stuff prefer that it was kept within professional circles, is what I mean. That's all I mean, So I consider you doing this course now, you've got to this stage, a professional. Because you're not using all the retail stuff. So that's why I got no problem sharing this stuff with you. So I guess I should have said that from the start, rather, because I couldn't think of the exact wording for it. But it's, professional people like to keep this between professional people. That's all. Don't want to put this out there with guys that are using, moving averages, trend lines, all that type of stuff. No, you don't, that's not a professional way of running the business. Now that you're doing things professionally, I'm happy to obviously put this down for you in black and white. So that's enough of that. I've gone on quite a bit about that. It's just, I just want to make sure there's no misunderstanding, basically. So what is this value expectations framework that I've put together? So if you think about it, right, I mentioned to you in task 1 how crucial it is, to identify conditions. Why is that? Because those conditions are going to determine, as I said to you, how we trade. But would you agree, we want to have some expectations. We want a framework, but we also want to have some expectations around that. So look, don't take this as gospel. This is just, obviously, like I said, what I saw other professional people doing. This is what I do, and this is what I've observed in the marketplace. But I want you to kind of keep this as a hypothesis, not the thesis that you do for the day, although this will help you form a thesis. I mean a separate hypothesis. Do a hypothesis for yourself and print this off. I'm going to put this in the download section for you. And again, I appreciate if you didn't plaster this everywhere, and I know you won't, because like I said, we're all professionals now. So, obviously be discreet with it, but I'm going to put this in the download section, and I want you to test this hypothesis. I want you to go and observe this in the marketplace, okay? So let's go through them very briefly, and then I'm going to go through the last 3-4 months of I haven't decided yet, maybe the S&P or the crude. Like I said, I don't want to cherry pick. I'm just going to do it off the cuff like that, and we'll see how many of these we can spot, etc. But let's have a look at them in theory, just very briefly. And I'm going to use this little space to go through all of them, because obviously I haven't got space for it. So they'll be very logical to you when you look at them. Balance, rotation, condition. What is the expectation in a balanced environment, right? Well, you already know that when we're in a balanced environment, what is the market doing? It's just doing nothing, right? It's just going up and down. It's gyrating like this. Not only this market, we saw in Cadbury's cream eggs. Obviously, the financial market has much more of a tendency to do this intraday throughout the day, because we talked about this. Supply is phenomenal, and obviously the price determination process is taking place second by second. So obviously the market does like to test the edges of balance just to see, are they going to hold? Are they going to hold? Are we happy? Are we happy here? Are we happy? It's all it's doing when it's balancing, right? So can you see what's the expectation when we're in a balanced environment? Is to test the other side, right? So it's not a great, obviously there will be, because do you remember the value area is really 70%? So there is going to be some sort of price movement taking place outside, isn't there? Like that, almost. That's more realistic. You know, you're going to get a 70% in here. So if the expectation is to test the other side of balance, right? Can you see, if we take a trade here, what's our expectation? We should have targets here, right? The other side. So value area to value area. This is going to help you develop trading strategy, okay? Whenever I'm looking at the market, I got my eye. If I'm taking a rotational trade, I'll be looking ultimately to test the other side of balance, okay? Now I've put here mindful of the POC or VWAP, which is in a VWAP framework. VWAP is obviously the mean, but it's the central area of value. It's that central area of value. What's the POC? It's exactly the same thing, point of control. It's where the most volume took place. Okay, so in the middle. So you'll see this when we get on the charts, and you'll see the point of control marked. So I'm going to tell you what I do. And obviously later on when I introduce the VWAP and we actually get you on the charts, this will become much clearer. For now, just start to think about this. Keep it in front of you. I'm going to put it on the side, like I said. Maybe have a printout or something. So you can start developing targets, expectations, okay? I'll be honest with you, even though they may not ultimately be hit, or I may change my mind, because obviously the market's giving me feedback as the trade goes on. Guys, I always have an expectation. I'm a business. You know, if you run a business or if you work for someone in a business, they have expectations about what? The price they can achieve. When you put something on auction, you got in your mind, I want to achieve this price. It's absolutely crucial. You know, you can't go into a trade thinking, I don't know where it's going to go. You can always extend the target. Don't get me wrong. I've seen some incredible traders go with it. If momentum comes in, they're going to extend their targets. See, what I've noticed is in retail circles, people get obsessed with fixed targets. Don't ever have a fixed target. That's not what I'm saying. I'm saying have an expectation and then adjust accordingly. But at least start with a base expectation. And typically in imbalanced environments, that's when you'll see the expectations can change, because think about it logically. When the market's imbalanced, it's got momentum behind it, hasn't it? It's got what? Aggressive market orders. And new people coming, come on, you know the markets are just people. They get emotional. They get, I don't want to miss out on the move. You get a surge of people coming in. And if you read the order flow and it's getting very strong, I'll do this all the time. I might add to my position and actually I'll say, do you know what? Forget my initial expectation. I'll change it. But rotational environments, typically, it's quite clear what your expectation is going to be, which is the other side of balance here. But what I'll do is I'll always take off some of my trade at the volume point of control, or the point of control if it's obviously a market profile, or the VPOC if it's on the volume point of control, but it's the same thing. And if it's the VWAP, then I'll always have the VWAP as a sort of scale target, because a lot of times what will happen is, so for example, we'll be fading it here, and you'll see it down here where I talk about if the POC holds, value builds, the market will get here, and sometimes it can just snap back in your face. You know, you don't want to get caught. So I'm always cautious, and I will always take some profits then. It kind of makes sense, right? Because yes, the market likes to overextend itself and test the other side of value, but the reality is, what is the fair price, the actual fair price? It's where, in theory, where the point of control and the mean is. Because why is that? Because in theory, it's where the most, in particular, where the point of control is. What is the point of control? It's the mode. It's where the most amount of volume took place. It's where there was price agreement at its maximum. So obviously, the market and algorithms, I can assure you, I don't think I've come across an algorithm in an institutional circle that isn't aware of where VWAP or the point of control is. And actually, this is a really important point, right? The reason why this value expectations framework that I've built out for you is so important is because, and I don't want you to worry about this right now, but it's important that you familiarize yourself with this, because you'll notice later, this applies to all value. That's why I've written value here. And what you've got to understand is profile, as you know, helps you determine value. I've kind of hinted static value because it's all historic. You'll see VWAP is exactly the same. It's all it is right? VWAP is profile, but it's developing profile. Because think about it, volume profile builds throughout the day. That is VWAP, essentially. VWAP allows us to visualize a developing profile in that intra period that we're in right now in a much more visually appealing and easier to read format. It will become obvious when I introduce the VWAP. Whereas historically, VWAP would just be a straight line, so we might as well just use the volume profile. This will become a lot clearer later. Some of you, this may just make sense straight away. If it doesn't, don't worry about it. It's not going to be, you're not going to make it. That's ridiculous, you know. There's certain things I got quickly. There's certain things, believe me, it took me ages to get. And everyone else in my sort of training group got stuff much quicker than me. But look, I'm still here after 16 years and they're not. So it doesn't matter, okay? What matters is ultimately at the end, are you able to develop edge in 9 months, whatever it is, a year's time, okay? So don't worry if you don't get it straight away. And I'm going to explain the VWAP stuff to you anyway. It's just that it is important that you recognize at this stage that this value expectations framework, it applies to all measures of value, okay? Algorithms that are using VWAP, basically every single one. Institutions that are using VWAP, every single institution. They're applying these conditions to it, not because someone just decided to invent these conditions. Guys, these are logical conditions. I've already explained them to you many times, although I might not have put them as 1, 2, 3, 4, 5, 6, 7 like this. When we did auction market theory, this was all happening, okay? And this happens in all traded goods and services. So just remember, A, that it applies to the VWAP profile, every single lens, be it a long-term value guy, short-term, and I'll show you this, okay? For now, just worry about profile, but it's important I mention that. And 2, just remember, this isn't something I've made up. This is logical, and it's happening because it's part of the auction process. So, you know, as I said, for example, we saw on that thing I showed you with Amazon, with the price of Cadbury's cream egg, where it was just going up and down. They were just testing the edges of value to see, is it going to hold? You know, businesses are doing this all the time. The market's no different. It's just testing, okay? So that's why the expectation's there, because the market's telling us that it's doing it. Okay, I've written my name there, like I said, and I know I'm repeating a point I said before, but it's important because I don't want people to see these as hard and fast rules that Envy's made. No, it's not, you know. And in fact, you can even imagine I didn't put my name there. It's basically what the market is doing in every good traded good and service in the world, including financial markets. And you'll realize this when you actually sit down and think about it. So that one's obvious. Expectation is to test the other side of balance. Another thing, what do we observe and see that the market does in rotational environments? Well, it's going to stay, isn't it? If the market's happy, why am I going to have any expectation if we're in this rotational environment like this, that we're going to do anything else? Why? I haven't got a crystal ball. Do you see what I mean? And this comes on to a really important point. I've noticed this. People get obsessed with forecasting. Guys, you've got to forget about forecasting. Do what the market's actually telling you. The market up there, as you can see here, is clearly telling you we're happy, we're rotational. If clues come in that we may go in balance, fine. Change your expectation. But when the market's actually telling you what it is, why? Why do you want to try and be clever and forecast things that aren't happening, okay? And I noticed this happen a lot. And again, look, I'm sorry, I know I keep coming back to indicators, but This is the danger with indicators. They set these they cause you to forecast too much and get your crystal ball out and think, oh, this could happen, that could. No, forget it. Let the market tell you what's happening. Market feedback is what? It's just gyrating within value. So the expectation is what? That we're going to stay rotational. Okay, so hopefully that's clear. We'll keep coming back to these. Look, don't worry, we will keep coming back to these. I don't necessarily look at this stuff, okay? And like I said, I've never actually written this down. I just took it for granted. And for me, it's just normal. But what it is I want you to know what not only my expectation is, but what every institutional investor in the street who measures value is looking at and what their expectation is. Because expectation can't be any different, right? At the end of the day, if iPhones are selling at, like I said, £1,000 on eBay or whatever the price is, let's say it's £1,000, for a long period of time, why, oh why, would you then go and decide they're going to be 2,000 tomorrow? It's ridiculous. Do you see what I mean? The market's telling you. And at the end of the day, investors, they'd be silly to do anything different to what the market's trying to tell you it's doing. So that's my point. These expectations are based on incredibly basic logic, okay? That's all it is. Keep things simple. You've heard this before. Keep things simple, right? This is what you're doing. Try and just keep it basic, have basic expectations, and then, yeah, there will be times, obviously, where you need to adjust, and that you'll develop. You won't be able to develop that overnight. That will come over time, but keep these in mind. Start off these as a base, and then, like I said, observe them and see for yourself and adjust accordingly as you develop through observation. I talked about this, a theory and observation phase. As your observation goes, you'll see little nuances. You'll see, oh, the market's giving me a clue that actually balance is ending. And I'm going to talk about this, shifts. And we can start to develop edge because you'll be able to see this before maybe an algorithm sees it or another institutional investor sees it. Okay, but we need a base to start from, and this is a great basis that I know for a fact all institutional investors are looking at. So number 3 is imbalance, right? So we've talked about what? Conditions. Can you see why I said in part A, identifying conditions is crucial? Because if you've identified an imbalance condition, your expectations is different, right? So let's get rid of, let's get rid of it all actually, just clean it up. So imbalance, right? You've identified, say this is a composite, very badly drawn composite. The market's doing what? It's doing this. And then what? The market becomes imbalanced, right? So it actually does what? Expectation is to stay rotational and balanced unless otherwise. So something changes, right? We start to do what? Build some value. Do you see? We're no longer gyrating around value. We're actually starting to build some value above. So the market is doing what? It's going imbalanced. Expectation is what? To go to previous balance. And I'm going to write over this, I apologize, but and I'm going to show you this when we do this exercise now. That could be a previous balance area. Okay, and I showed you this loads of times, didn't I? Do you remember when I said traded goods and services, milk or whatever it was? Do you remember I said there could be a collapse because of, I can't remember, there was something about cows or something like that. And then I said when that gets fixed and obviously the health of cows, I can't remember exactly, I believe it was, goes back to normal. Where's the market going to go back to? Previous balance, right? So what do you think the market's going to do here? Go to previous balance in the past where the market's been happy to trade. Do you see what I mean, guys? It's just logical expectations. It's not some made up expectations that you can go and back test. And no. This is happening every day around you, okay? More than you realize this is happening, okay? This is happening in the price of just the most random things you can imagine. I've said it before, Diet Coke, salt, pepper. I'm just looking at things around me, keyboard, mouse, paper, jacket, phones, everything is doing what? if it shifts from value, is typically going to go to somewhere where it's traded before. Obviously, there's going to be times where it can't find previous value, and in which case it has to obviously go through a price determination process where it will just it will basically keep going imbalanced until what? Market orders come in the other way. And that's where I said, look, these expectations can change. Obviously, you can change when that happens, but that's more advanced. That's going to come when you keep observing the market. For now, let's just keep it basic. If we go imbalanced and there is an area where the market has traded before, obviously it's going to go there, because where else can it go, right? At the end of the day, if it's traded, we talked about milk. If it collapsed to 50 cents, 60 cents, and it's traded at $1.50 historically, obviously if it goes back to normal, it's going to go back to $1.50, right? It's ludicrous to have an expectation elsewhere. Yes, I agree, something different could happen, and that's your job as a trader to adjust, but you need an expectation, don't you? To build a plan, to build a hypothesis, to build a business. When you go into business, do you just go and blindly sell things and buy things? No, you have an expectation with a price you're likely to achieve. Doesn't always happen, but at least that's your base scenario, your hypothesis. Okay, so this is, and we're going to come back to this building hypothesis, but this is why we're doing this, so we can start to develop a plan for the day. I hinted at this before. Let's say we've got this composite here, we've got a composite there, and we see the market developing, and you'll see this on the VWAP framework, developing value here. I'm going to start thinking, you know what? I could have an imbalanced trade opportunity here. Where am I targeting? Up here. Obviously, order flow can come in here, and I might change my mind. I might scale out. I might decide, actually, you know what? The buyers have run out of steam, market orders, something's changed. It could be, I don't really look at fundamentals, but obviously I'll be aware of them, right? If there's a big news release and something's happened and the market's clearly telling me it's not happy, why would I hold it till there? But it's my base scenario, right? When I started, the expectation was there when I started the hypothesis. So hopefully you don't think I'm just saying all of this for the sake of it, and I hope this is really making sense to you. If it isn't, don't worry about it. We can go over it and 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 over it. That's the whole point. That's how you're going to learn. You're not going to get it the first time, but I'm trying to give you some guidelines that you can develop yourself, right? So we've covered that off. Now let's look at shifts. Okay, so before we talked about actual conditions and remaining in those conditions, and within rotational conditions, what should our expectation be? With imbalanced condition, do you remember I said to you, market's only balancing and imbalancing. It's not really doing anything else. So in those environments, what is it doing? But obviously there's going to be times where there's a gray area, right? Where it's shifting. Of course it's going to be shifting. It doesn't just suddenly flip from balance to imbalance. There's obviously a transitional phase, isn't there? That's where you can build incredible edge, because you can identify that, right? So how do we do that? Well, we need an expectation again. So let's look at shifts. So one is balance to imbalance, right? How's that going to happen? Well, I mentioned it above. We're in this balance area. If the value area is broken, and what do I mean by broken? We build some transaction. So what happens here? You start to build some volume. I don't really want to get into that right now, because obviously that's a bit more advanced. But if you've been watching the depth of market, can you see why I got you on the depth of market? It's incredible how powerful it is, the time you spent on the depth of market. Because imagine I'd never got you on that and I said, yeah, guys, we get some value here and we just start building volume here. You're going to think, what is he talking about? We've been in the depth of market. If I tell you market orders start coming in here and we get value here, you're going to be like, yeah, do you know what? I've seen that. I've seen that 1,000 times over the last 3 months. It might have been boring, but I saw that. I know what Envy's talking about. I can look for that now. So do you see, you can see some value will start building here on your volume profile or market profile, whatever it is you want to use. And I do combine them. But at this moment, you can imagine, I don't want to, because it's going to confuse you if I start showing you combinations and all of that. Let's just stick to market profile for now. But point is, market orders are obviously building, and there is profile building here. But what is the point? Value area is broken. What's my expectation when the value area breaks? Is it for us to come back into balance? No, of course it's not. It's for us to go imbalanced, okay?